Good evening, this is Rodney with the Triton Wave Market Outlook for Monday, May 6th, 2013. All right, well, I hope you all enjoyed the Cinco de Mayo holiday and ready to get back to work and have some fun with the market. This is Triton Waves. This is the first one, just a summary for those of you who are just joining. Triton Wave 1, 2, 3, 4, 5, otherwise known as T1, T2, T3, T4, T5. Okay, we see this made a nice bounce in around April 16th, 17th, right off here, off the 55 exponential moving average. And we also see that the small wave on T1 is still below zero, even with the 5 o'clock opening on Sunday. It's right now 8 o'clock Central Standard Time on Sunday, Cinco de Mayo. All right, now this has ridden a crest along the 8-period moving average, and it keeps moving up. Now, these waves, as I've said numerous times before, these are non-confirmation lower highs, lower highs, lower highs as the cash goes up, up, and it looks like away. I mean, this is just like getting carried on. So you can look at it as a stock market or as a market of stocks. And you can't really go out and just buy a basket unless you have an incredible amount of money of all the S&P stocks. So you either buy the SPYs if you want it to go up, or you concentrate on counter trend trades, which I like, which are shorting positions, because every time they seem to run up, they take these nosedives down, and stocks do this, and the market does this, but stocks tend to do it independent of the market. And so, of course, I'm always looking for when the next takedown is going to be right here. So, breaking this down a little bit more, this is a picture of the 144-minute chart, cash price. This is the cash price right here. So it doesn't reflect the overnight trade, and I think we're up like 125 overnight on the S&Ps. Let's break this down to a 21-minute, which is again the cash price, and we see this. It's had a nice trend up for several days now. You know, even the wave 5 on the long wave since April 23rd, and it's been up. Even with these little hiccups on the downside, on the shorter waves, the long wave has definitely been up. There's no question about that. All right, let's look at some of the trading waves here. Let's look at the 1597, which is a trading wave. And those were hard to do. This was the, I'll tell you why this was hard to do, is because this looked like it was really had a potential of going down with all these below zero, or about either below zero right here, and here, and here, and here, and this was about to go below. Guess what? Came out at 7:30 in the morning with unemployment news that it wasn't spectacular. It was okay, but it was better than everybody expected. So, if you don't mind my taking a moment, I am going to explain why this market is going up. It'll take a couple of minutes, but it might be worth it. This week in news, Mario Draghi, sounds like a drag, but Draghi of the European Central Bank, the ECB, dropped the rates a quarter of a point to 50 basis points. Okay, that's what was announced, and the markets took off like crazy. Let me get a daily chart back up here. I think that's part of the reason of this continuous move up, like all week long. Okay, drop the rates to half a percent. What he did not say, and implicit in what he did not say, is that the rate at which banks deposit their cash to the ECB was cut to below zero. That means these banks, these outside banks that are depositing to their, like their depositing to their central bank, the ECB, like our Fed is a central bank. Okay, so they're getting paid on their deposits less than zero. So the implication is that in order to avoid being paid less than zero to deposit their money, other banks' money into the central bank, the idea is for them, the banks, to pull out their money from the ECB and into the economy, thereby stimulating the economy, or buying their government's debt instead of depositing into the ECB. Okay, so I don't know if you're aware of this, but there are some money market funds that are less than zero. Pay less than 0%. So you almost have to pay a small fee to have your money in there just to have it in cash. So a long time ago, like in August, September, when there was an infusion of money that Mario Draghi put in right after, on the heels of Ben Bernanke, and I called it, and it looked like a bubble on a chart, and I called it the Ben Draghi bubble. Well, this sounds like another scheme, actually, because right now they're pouring so much money into the system so that it won't crack that Nouriel Roubini on May 2nd, which was like 3 days ago, he said the exit from the Fed's QE and the zero interest rate policies will be treacherous. Exiting and I'm doing this is a direct quote from Nouriel Roubini on CNBC. Exiting too fast will crash the real economy, while exiting too slow will first create a huge bubble and then crash the whole financial system. So basically what's happening is, if you're getting less than zero return on your money market funds and nothing else is working for you in regular bank accounts, then of course you're going to put money in the stock market. That's the only game in town. But as you may note, what I said last week or the week before, when you are the only game in town, it's a very, very dangerous situation, because you might bubble up another 5%, another 6%, and then you may lose probably half of what you have. Don't play the only game in town. Have some protection. And just because you have KIOs and IRAs and self-directed funds, you have 401ks, your 401k could easily turn into a 201k. It happened in 2008. It could happen again now. And I just want to add that this is like, I don't know if some of you are old enough to remember the Oldsmobiles and the Cadillacs and the Pontiacs when they had 350 horsepower engines in them. Those engines were the best engines that General Motors ever put out, as far as I'm concerned. And they would literally run 3, 4, 5, 600,000 miles, because I've done it. My parents did it, and they were. But what was nice about them, they were made up of all parts they were complicated, but they weren't. If one part broke down, the other parts would still work. So basically, what I'm trying to say is, if you had an 8-cylinder 350 car, 350 engine out of General Motors, You could actually operate that car in 6 cylinders. Two spark plugs could break down, a distributor cap could get dirty, and it would sound like rusty and you would like chug along, but you would make it to the next gas station to get help. Okay, now and that's the way the stock market used to work. Now, with the sophistication of all the automobiles and brain centers, control centers that they call brain centers of the car, anything goes wrong in one of those, not only does your car just stop midstream in the highway or on any road that you're on because it can't get along without it, and it costs you like $600, $800, $1,200 to replace it. All I'm saying is the markets are like that now. If anything goes wrong, and anything technically, you could have a glitch. You know, when they used to have a lot of people on the floor of the New York Stock Exchange, the Chicago Board of Trade. If, you know, somebody was out sick, half a dozen people were out sick, it still operated. But now if a machine is down sick, it just doesn't work that way. The whole thing freezes up, and we've seen that happen this week. I believe it was the Chicago Board of Trade. I don't remember. It was locked. It was locked up for like 3 or 4 hours. That kind of stuff can happen. It can happen in flash crashes. It can happen anywhere. All I'm saying is just be careful. And as a final note, Lloyd Blankfein, who is the chairman CEO of Goldman Sachs, said in an interview on CNBC, yes, the economy is moving along, and yes, people are buying, and yes, unemployment is getting a little bit better. But he was kind of shrugging his shoulders at all the positive stuff, and then his eyes lit up when he said, but the stock market's going way up, so people are making money on their investments. That's not the economy. That is a figment of everybody's imagination of what they want the economy to be, and it's not. Mark my words, it is not. So protect yourself with this balloon, and let's take a look at some stocks. Okay, we'll take a look at Apple here. Apple on the last 2 days of trading, actually on Friday. I'll blow this up for you a little bit. T2, T1 has been above zero, but T2 just went above zero, 2.1 for the first time. And it looks like T3 wants to go too. So I really don't remember the target that I had on this. I said if we got above actually the target was 440, and now it's at 449. So it could easily go back to this yellow line, which is the 89 exponential moving average of 460. And we'll just kind of like play it by ear. Let's see what the that's the daily. Let's see what the 21 looks like. The 21 looks like it wants to shave some stuff off. Here's 21 saying it may not make it up that high. The daily looks like it. The 21, which is actually almost like real time of what's happening, is that it got close to this area of the 1597 exponential moving average. This is again the 21-minute cash price on Apple. But these are all okay. Let me see. This just went below zero right here on like the last few minutes of trading on Friday. So you know, the daily. So the daily doesn't look too bad, but I don't like the 21. And it may eventually go in the direction of the daily, but right now I would hold off. As far as let me see if we can get some maybe 377. Okay, when Apple did its kind of like weird spike here, it threw the waves way off. So they haven't really recovered yet from that weird. Went from 406. This is like overnight trades, which incorporates the waves. 406, 429, back to 391. It completely corrupted all this. So let's look at a 987. they're just starting the waves are just starting to come back in line so that they're legible. So we're gonna have to stick to the daily in the 21. Let's take a look at Goldman Sachs. Hopefully that's not corrupted. And on the daily on Goldman Sachs, let me see here. Okay, it was up 170 on Friday, and I think I mentioned to you that the market is as the market is climbing, it's climbing. The market's going up like this, the Dow, and that's why when I said you can either look at it as a stock market or a market of stocks. Look at Goldman Sachs. Boom, like this. And all these guys, T1, T2, T3, these are completely below zero. These are the trading waves, which on the daily are the trading waves, and these are just the backup waves, the anchor waves. So let's take a look at the 21 here. 21 it bounced up and then it came back down again, and the 21 doesn't look so bad. Let's look at the 144 if we can get that filled in here. All right. This is the 144 cash price. It's just a lot of resistance in here. I would be surprised to see, once it dropped below, once these moving averages drop below, it's kind of been riding the crest of the 55, which is the red line, and then it rode below that, came up to it, up a little bit, and then below it, and now it's just hovering right at it. So in the meantime, these are kind of moving up slowly, and we may see a little action. We may see this try to pop a little bit with the market. But right now, I don't like Goldman to the long side, because there's been way too much movement in the stock market, and Goldman's just kind of gone sideways to up a little bit. And I tend to think that in any directional and any big directional moves, it's going to go in the direction of what the daily is. So the 21 may look good, and the 5-minute may look good, and the 987 may look good, tick chart. But in the final analysis, when shit hits the fan, and these are already below zero, then these move even more quickly below zero. So that's all I have for tonight. Shorter than usual, but still a little lengthy. Have good trading, and I will see you at the next update. Enjoy the rest of the evening.